Good morning, everybody. It is January 7th. I am Kirk Spano, and we are going to talk about inflation. We're going to talk about the Fed. We're going to talk about cryptocurrency and about our ETF playbook for this quarter. So why don't we jump right on into it? You will remember this slide from about a year and a half ago. I said the market was delusional and over-leveraged. And this is actually the same thing that I said back then. It's just more now. So what we have run into is the phrase, markets can stay irrational longer than you can stay solvent. Yeah, luckily I wasn't shorting anything, but the people who were shorting have just gotten creamed. Now they're getting their chance to make some money back. We'll see if they will, and we'll see if they won't. But what we really want to pay attention to is how can we make money? So let's look at the reality of the market. We are the most overvalued in history, or the second most overvalued in history, depending on what chart you want to look at, which measure of valuation you want to look at. The Crestmont geometric mean is something that I pay very close attention to, and it is through the stratosphere. If we jump down here to the Buffett indicator, we will see that, again, most overvalued in history. And what is this? This is basically what it would cost to buy a business on the stock market versus what it would cost to just start the business. And usually there is a premium. There's been more of a premium in the last 20 years, but right now the premium is huge. On the stock market, you're basically paying double for a business versus what you would have to pay to just open the business. And that's why so many small companies have come public. It's because they can take a private company and take it public and get an immediate boost in valuation. And it's also because there wasn't a lot of sense in buying the large caps when you take a look at what is that really going to return to me in profits over time if I'm paying this much for the shares. Buffett has been accumulating cash now for a couple of years again and is sitting at about $180 billion. And I identified about $100 billion worth of things on his public balance sheet, the public stocks that he owns, that he probably could have sold pretty easily here in the last quarter. So I'm looking forward to seeing his 13F to see if Berkshire Hathaway is over $200 billion in cash now. My guess is that they are. We will see imminently. This is the stock market adjusted for inflation since 1871. So you can see that we are again way above the mean, way above the trend line. Does it mean that we ever get back here to under the trend line? Someday, but I don't think that day is soon. Although I do think we could approach something in this range pretty easily. Standard deviation. Remember that class? You hated that stats class too. I know that I did, but it was exceedingly useful. Measures how far outside the range of normalcy we are. We are at a 4th standard deviation right now. And really, this is a couple weeks ago for valuations on the stock market, S&P 500. This is from Crestmont. Shows the periods of bear market and bull market. Are we due for an imminent bear market? I don't know. I think so. That doesn't mean that the stock market can't go up for another year or 2 or 3. A lot depends on the Fed. I know that there are some personalities on Seeking Alpha and other places who say the Fed doesn't matter. Just watch market sentiment. Well, like I've said, liquidity speaks and then sentiment listens. And if you've been paying attention the last few weeks, and I'll show you some headlines in a minute, as liquidity is shifted, so is sentiment. Not all the sentiment. The little guys still aren't scared. But the big guys, they've been paying attention and making some changes to their portfolios. This is FINRA margin debt. I popped this up here so that you understand that not only are we significantly overvalued, but margin debt is through the roof, just barely coming off its peak. So what does that look like to you? When you make the chart inverse of the market, looks a bit like an alligator, doesn't it? Last time I talked about that here in 2018, which somebody gave me a review saying I called that perfect, so the alligator jaws would close. And they did a little bit. But we haven't seen the big, huge correction that people like Jeremy Grantham and Jimmy Rogers are talking about. Are we going to? I don't know. It would be difficult for the Fed not to step in at some point because we have a retirement system that's going to come under huge stress when the very last baby boomers get on Social Security and Medicare late this decade. I have talked about the baby boomer collapse and crisis extensively since 2012 on Market Watch. I said that it's coming in the end of the 2020s. I'll stick with that. I do think the pandemic was a reason for the Federal Reserve and the federal government to pull forward a lot of those bailouts from the future to now. And I'm sure they're hoping to mitigate the boomer collapse when that demographic shift finally hits us square in the mouth and reminds us that the Great Recession really was just the beginning of a generational shift that was going to take somewhere between 20 and 40 years. Let's hope it's to the short end of that and that we are getting over it by 2030-ish. There's a lot of bad things that could happen in a world where there's massive debts, but on top of those massive debts, there's massive obligations of dependent people, senior citizens that need health care, that don't have enough savings to feed themselves and stay sheltered. So the question becomes, what happens when 80% of the population over the age of 65 is saying, help me? Because that's what's going to happen in about a decade. If we're lucky, it'll only be 50 or 60%, because affluent children will take care of their parents. In the United States, that hasn't really been the case the last couple generations, but in Europe and other places around the world, it has been for centuries. I believe in the United States, we're going to have to move back to a model where we help our families more. We'll see if people will accept that. There is a very strong self-interest streak in this country. I won't call it selfish, but self-interested for sure. And we're going to have to get over that. In the meantime, the stock market keeps on partying, kind of. So what could happen? Let's go back, take a moment to remember slow growth forever. What is that? It's the idea that demographics are destiny. And if demographics are destiny, then what I just talked about with some sort of a baby boomer bust around 2030 is the overriding demographic theme and economic theme that we have to always have in the background. It's why the people who pound the table, inflation, 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 have been wrong for a very long time. And after this little cycle of inflation is over with, and I'm going to show you in a moment that it's almost over, deflation is the real boogeyman, because an aging population spends less money and creates less economic value. And against massive debts and obligations, that is deflationary, not inflationary. This inflation is temporary, it is transitory, it'll be gone in about a year or two, and then we're going to have to worry hard. We're going to have to worry hard about where the growth will come from. And if Joe Manchin sinks the Build Back Better bill, and then Republicans take the House and cause gridlock for 2 years, we could be in for a lot of pain. Here's the Consumer Price Index. Inflation dropped to around 2% and even further below that during the Great Recession, but it's been around 2% for a long time. It's spiked up here. People want to say, oh, it's Biden, or oh, it's Trump, or oh, it's this guy or that guy. No, you know who it was? It was this guy coronavirus, with an assist from the shipping industry trying to gouge, and the Chinese trying to use supply chains to their advantage on trade, and OPEC trying to get what they can out of their assets. And it's already peaked, started to come down. It'll jitterbug, but the rate of inflation is just going to keep coming down. There can be a quarter here and there where it pops up, some event, some reason. Don't believe me? This is the Consumer Price Index without food and energy. So everything else, basically no inflation. But wages, doesn't matter. Just doesn't matter. Wages are offset by productivity. And technology, even if we don't measure it well, makes us more productive. And what we've learned is that people given a choice of working from home, at least part of the time, get their work done. Why? So they can go out and screw around. They're home. So all that water cooler time, all that time flipping pencils off your desk, all that time reading the paper when nobody's looking in your office, all that wasted time at the office, which I've always maintained that was over half the time the people are in the office. Now people just do it at home and do something else. The amount of work that people can get done in 4 or 5 hours in a day is pretty big. You don't need to be in the office 7 or 8 hours a day to get your 4 or 5 hours worth of work done. There's a book out there, was a 4-hour work week. I don't know the whole thing behind it, but the idea that we really need to work 40 hours a week to get our work done, given what technology has done in the last 20 years, it's just not true. The paradigm has shifted. We glom onto the 40-hour week because it's always been a 4-hour week. Oh, tradition. I think there's a play out there about that, right? Tradition. The 30 to 35-hour work week is coming. It's overdue, and it's about to happen. And that plays into the whole inflation factor in unemployment, in people's standards of living, expectations about society. No inflation, X energy and food, right? This is with the energy and food. And this is without shelter. So even the cost of housing hasn't crushed people yet. Now imagine if energy and housing prices flatten, not even fall, inflation's basically gone at that point. Because I showed you the chart of the sticky inflation, it's already level. So get rid of housing, energy, and food inflation, and there's no inflation, zero. Not 2, not 3, 0. It's already happening, right? We've seen the price of oil come down off its peak, and now it's just been jitterbugging around, chopping around. OPEC announced, 2 days ago, what I said they were going to announce is even more oil coming onto the market. Why? Because they don't want stranded assets. OPEC knows that the oil age is beginning to end. That's why they flooded the market with oil in 2015. Their goal is to be last man standing with oil, and they will be, because then they can have a stable price for decades as demand for oil falls in the 2030s and 2040s. They don't care because they only produce 30 million barrels a day. As long as they're selling theirs at $60, $70 a barrel, they're happy. They don't care if the Americans can sell theirs. And given that it costs a lot more money to produce oil in America and Russia, OPEC's in the catbird seat. So if you really want to own an oil company, buy Saudi Aramco on a correction. That's the company that's going to win. Cheapest oil, lowest cost. In any case, inflation and unemployment, we've talked about over and over again. And everybody wants to talk about the Fed's dual mandate. Sure, that's the cover. The Fed's main job is to preserve the dollar. And I've showed you the dollar chart going back for a very long time. And how in 2012, I said, when everybody else said the dollar was going to collapse, that the dollar would go on a long-term bull market. And I listed 20 reasons why. Those reasons still exist. And in the digital currency age, with a digital dollar coming, it's even stronger. The dollar is going to keep getting stronger. We'll let it get weak once in a while when the world needs it. But the underlying strength of the dollar is so massive that we can deficit spend, not quite at will. There are some limits, but the bumpers for the United States are so much wider than anybody else that if there's a crisis, we can print $1 trillion here, $1 trillion there, or 10 trillion. Not a sweat. We just did it, and your cucumbers now cost 20 cents more. All right, let's reflect on that for a second. Back to the alligator. Half of the stocks on NASDAQ are down by 50% or more from their highs. How can that be? NASDAQ has barely moved, still flirting with its highs. How can that be? Well, it's true. So what are we waiting for? And if NASDAQ is already getting hammered, small caps were crushed in the second half last year, what's going to get hammered next? Or what's starting to get hammered? Crypto. We'll talk about that for a second. The broader S&P 500, REITs, and oil. Probably the 4 things you got to look at. Although I still believe oil will just be range bound for a really, really, really long time. Somebody put the answer in the chat. The broader S&P 500, particularly the biggest companies, haven't gotten hit yet. When they get hit, the correction's pretty much over because the rest of it has already happened or is in process. So let's talk about cryptocurrency. So people wondered whether Bitcoin would be a hedge on inflation. And over a very long time, it probably is. However, in the short term, it's just a trading vehicle. And a lot of people treat it as a trading vehicle. A lot of headlines, these are from weeks ago, most of them, about why cryptocurrency is getting beat up. I'd say focus on this one down here. These are all about the Fed, basically, tightening up liquidity. Well, why would tightening up liquidity matter? We've talked about this before too. In a market that's driven by options, and we've talked about this in the context of stocks, the meme stocks last year, options and leverage, when liquidity dries up, it's harder to finance your options and maintain leverage. And therefore, the assets that you were buying, the underlying assets, have to come down in price. So Bitcoin traders in the spring during that last correction were using leverage at about 100 to 1. What does leverage look like today? Yes, I'm one of those quant guys. Told you I'm a quant guy, and nobody ever believes me because I don't throw it around. But I'll start putting some more quant stuff out there if you want. The purple line is the rough leverage on cryptocurrency right now. Bitcoin, estimated leverage. Notice a trend. Here we have some alligator jaws. Eventually, leverage comes down, Bitcoin bottoms, and then turns back up. So there's more to go on the downside for Bitcoin, and they'll move in the same direction for a while. And then when leverage gets low enough, Bitcoin can bottom, and then as they rebuild leverage, come back up. What price did I tell you to watch on Bitcoin? between 20 and 30,000. Now, a lot of people are saying upper 30s, 36, 37, 38,000. And that could be right. But as Shooter pointed out, I believe in today's chat, maybe even last night, Elliott wave theory, which is one of the things that we use, often undershoots at tops and bottoms. Why? Because it can't really account for abrupt short-term moves in liquidity. Those are places where charts break down when there's a change in circumstances. And liquidity is the biggest circumstance that could change. So while a lot of people are pointing to 37,000 on Bitcoin, I would probably point to around 30,000. And if there's momentum to the downside, if there really is a big liquidation, and there could be, there's certainly incentive for the Fed to want to see that happen, right? Because their job is to protect the dollar. You could see Bitcoin get down into the low 20,000s, make a run at 20,000. I don't think so, but maybe. I will tell you, I probably won't buy any Bitcoin unless it gets down close to 20,000. Where will I buy it? I'll buy it here. This is not only a stock that is on our stock list now. The reason I use Coinbase to buy my cryptocurrencies is because it's easy. They're basically industry standard. They're way bigger than anybody else at this point. And there's a couple of big competitors coming. I like that for new investors. They have these little earn and learn things where you watch a couple videos and learn how a particular cryptocurrency works. And they'll give you a fractional share, usually worth like $2. But it's a good way to learn about cryptocurrency. So for those of you who are like, oh, I don't think it makes any sense. Look, if you don't think it makes any sense, it's because you haven't studied it. Cryptocurrency is here to stay, even though 99% of them are going to zero. Bitcoin's here forever. Ethereum is probably here forever. Now, whether it continues to dominate or not, or becomes part of a fragmented system, I don't know. Ethereum, of course, is what underlies digital contracts, which I think are going to change the world of banking, of real estate, of collectibles, anything that has to do with a contract on an asset, and really even a contract on construction, or manufacturing. So there are cryptocurrencies out there that I think you should be looking at while these people get ready for election season. The last time I told you to think about cryptocurrency was summer of 2020. I told you to buy Bitcoin with 1 or 2 or 3%, maybe even 5% of your bank savings. I'm going to tell you the same thing. Now, if you want to trade cryptocurrency, have at it. I'm not doing that. As you saw in my stock picks, I included a cryptocurrency section, and in my annual letter, I am accumulating Ethereum. I'm going to start accumulating some of Ethereum's top competitors. Why? Because in the future, if you have enough of it, you can loan it out, or you can build your own computing setup. I'll probably partner with people and do that. But for you, if you accumulate enough cryptocurrency, you can loan it out and get paid interest. And again, I don't think it should be a giant part of your portfolio, but it's a hedge. It's another part of the financial system. If you believe in CDs or government bonds or money market accounts for keeping some of your cash, cryptocurrency is another alternative. Now, the fact that it's volatile and can be traded right now is this point in history. Eventually, the cryptocurrencies level out and just have a slow drift upwards. The survivors, not the 99% that are going to zero. Because you really aren't going to use Bitcoin or something like that to buy your pizza or buy your shoes or even to buy your tickets at a baseball game, I don't think. Why? Because at some point the government says no. China's already doing it. In this country, we seem to have a strong tolerance for being imposed upon by the government, even though we say we don't. So don't expect the dollar to go anywhere, just expect the dollar to adjust. And if you've been following Tether and other stable coins, what you realize, and Congress is talking about this overtly, people like these two exciting folks, that stable coins are just going to be regulated like money market accounts. Why is that important? Because money market accounts have to have a certain type of asset in them that are liquid and stable. What's the most liquid, stable asset? Short-term treasuries. So cryptocurrency isn't going to take money out of the treasury system. It's going to put money into the treasury system. Think that through. All right, let's get back to investing. This is our barbell. This is where we want to be. About 80% of your money over here, 20% of your money over here. Why only 20% over here? And I think you can go lower sometimes. It's because hard assets that are securitized aren't always the best assets. Should I slide over a little bit? Oh, that way? No, that way? That way? There we go. Hey, I'm way over here. Look how fat I am. All right, so all energy here would be your yield codes. These are your commodities, gold and crypto. REITs. Problem with REITs, of course, right now is that they're grotesquely overvalued in many cases. So buying them is hard. But if you're a retiree, having a big slug of REITs, maybe 10, 12% of your portfolio isn't a horrible thing. It's representative of a hard asset. But remember, most of you own a home. So always consider the fact that you're already exposed to real estate. If you're about 80-20, maybe 70-30 if you're retired, or even 60-40, it's probably about the right asset allocation. And within that asset allocation that's broad, these are the things in the growth side that you want to pay attention to. The problem with biotech, of course, is that it's very hard to track. You usually want to use a fund for that. Alternative energy, a mix of funds and selected stocks, same thing with all of these. So let's take a look at the S&P 500. S&P 500 is 30% technology. And this is a point that I have a hard time making to retirees when I tell them you should be at least 30% technology. Well, that's risky. It's not risky. These are the richest, fastest growing companies in the world. Just a fact. They make more money. They're sitting on more cash in better businesses with less risk than all that old man stuff. I would argue that most people should be 50 to 60%, double, 50 to 60% technology. So half technology and half everything else. I think you could even make it 2-to-1 if you're aggressive. If you're 50 or younger, 50-ish or younger, if you wanted to be 70, 75, 80% technology, I don't think you would be doing yourself a disservice. But again, I think about 50-50 is probably right for most people. And this is why the indexes haven't come down yet. Half of these companies have gotten beat up. This is half the index, these 6 companies: Apple, Microsoft, Amazon, Alphabet, Facebook, Tesla. Tesla and Facebook have started to correct already. So when these stocks correct, when they finally take their 10 to 30% correction, Tesla could be more, Facebook could be a little bit more. That's when the correction will be over. Because pretty much everything here has already gotten beat up. And the last wave down will be when people panic and start selling off some of their index funds. And that'll be it. Done. Over with. And if it's not over with, the Fed will come in with a bucket of money. This is QQQ. It's half technology. And this is why I tell people to buy QQQ. It's a better index than the S&P 500. That's a good asset allocation. You buy your REITs individually because there is not a good real estate ETF or mutual fund in existence. None of them. Not a one. Not Cohen Stearns. None of them. You're better off just buying 5 or 6 REITs on your own. So with this, you had REITs. Maybe you buy a couple more, you buy Pfizer. I've talked about their mRNA platform. It's a good one for a retiree, pays a fat dividend. COVID's not going away this century, this decade for sure. It's done pretty well. Where can it get to? Well, so we have our box here. It's updated. If the Fed allows the market to come off of some of those super high valuations that I showed you earlier, and this bottom line is about where it should go. QQQ will end up on one side or the other of 300-ish. So 320s, I think, is probably going to happen. Can it get down here to the 280s? Maybe. We'll see. And that's not even 2020. This is just 2020. All the years it took. All these years it took. Not that long ago. It was way down here. This red line represents basically the equivalent of a speed line. I mean, it's not impossible to get all the way back here. It's not. I think it's unlikely, but it's not impossible. I think you have to start buying in here, here, and here, depending on what the downward momentum is and the situation is at the time. If the Fed is still tightening, you got to be careful, because the last time the Fed tightens marks another change. I originally thought the Fed wouldn't tighten, not raise interest rates, I should say, at all this year. I'm probably wrong now. Looks like they will raise interest rates, so I'll up it to 1 and done, but we'll see. And maybe it'll be an interesting raise. Maybe it won't be a 1/4 point, but it'll be a 1/2 point. Mohamed El-Erian's been talking about how the Fed was behind the curve. I don't believe that. I think he's wrong about that. Just like I think Jeff Gundlach's wrong about the dollar collapsing. I've been right for 11 years. He's been wrong for 11 years. He's a lot richer, though, so who cares? The reason El-Erian is wrong is because the Fed is getting what they want. They really are. They're protecting the dollar. They're saturating the world with dollars to keep the dollar the premier currency. The more dollars there are in existence, the more people are using it. The more people who are owed dollars, the more they're going to make sure that dollars are still a thing. Take a look at what's happening in China right now. I've told you that Bitcoin was created, or at least adopted, by the Chinese to launder money out of China. You look at the crackdown on Bitcoin going on in China. The policy is basically saying, yeah, Crook's right. All that money was leaving China. It was leaving China through Bitcoin and by buying real estate around the world, particularly the United States. And now they're cracking down on it. Both things. And that is actually something to watch, is China. And we'll get to that again in a second. How far down can this go? This is a level of support right in here. This is a level of support right in here. If it breaks below here, that opens the door to head all the way down here. So, you know, when you watch an Elliott wave guy say, oh, it could go here to here to here. But if it goes past here, it could go all the way to here. Same thing. Doesn't matter what technical system you're using. If you've been paying attention over fundamental trends, you'll notice that Shooter's charts and my charts overlap all the time, and I'm not even using Elliott wave. Why? Because I can eyeball it and I can see the same thing. I don't need all the A's, B's, and C's and Q's and R's and W's and whatever else he's got on his charts. He likes it. It works for him. Works really well for him. I just can look at a chart after 25 years and say, okay, here's the waves. Shooter put up an interesting chart on Amazon yesterday and shows that if it breaks, the purple line can head all the way down to that C level that you see. I'm not annotating here, but if I were annotating, that little green dotted line with the setup long, and you could see Amazon go down to 2400-ish. And if it does, that probably represents the end of the correction, unless there's an Armageddon scenario. And that pulls QQQ down into the orange box. So barring an Armageddon scenario, which I don't see coming, just watch these large caps. And when they correct, buy your 20 favorite things or your ETFs. One of the ETFs that we're going to buy is QQQJ. That's the next 100 stocks on NASDAQ. A lot of interesting names in there. PTC, Roku, a bunch of other ones that are on our list. Roku's kind of on probation right now at a low enough price to be worth buying. So QQQJ, another one that we can buy soon, sometime in the next several months. Another one that's high in information technology, but also healthcare. So we're getting exposure to biotech without having to try to figure out which company's got the next big thing coming. I truly do think buying biotech, unless you really understand the company, you know, like their catalysts and the dates and the people and the FDA stuff and everything else, you have to really, really know inside and out, the way that I knew Exact Sciences to buy individual biotechs. You can trade them. You can trade them, you know, if you're just technical trading. But to own them, you have to really, truly understand them. And I think for most people, the best thing to do is just buy the baskets or get ETF exposure when the group is beat up. It's probably the best way to beat the market by several points without having to take individual company risk. Remember, the only reason you would ever take single stock risk is if you think you can beat the market handily without taking a lot of extra risk. You know, biotechs, you're taking a lot of risk. So I don't even have really any biotechs with the exception of Ginkgo Bioworks, which is a platform, not a product company. I don't have a single product company on my list right now. They require a lot of work and effort. And you're wrong all the damn time. I got lucky on Exact Sciences that it fell into my lap. I understood it. I put extra time into it because it was a hometown company. I was like, oh, wow, this one could be a 10-bagger. And it was. It's hard to find biotechs. Buy the baskets. You can get asset allocation exposure through QQQ and through QQQJ and some of the other funds that we're in. And if you really want more, you can buy a biotech fund. I think Kathy Wood's fund is outstanding if you want something managed to go along with your indexes. So let's talk about emerging markets. This is the emerging markets fund that I've been targeting for a year, and it's finally getting down to the buy zone. You know, remember a year ago, a little over a year ago, I had all these orange boxes way below these prices at the top, these peak prices. And people were telling me, well, we're never going to see those prices. I was like, yeah, we will. No, we won't. It's not going to happen. It can't happen. Well, you're seeing it right now. It's happening right now. Look. Well, that way. It's happening. So now isn't the time to get scared. The time to get scared was way up at that top when a lot of people had FOMO. Now is the time to be thinking, okay, how am I going to scale into this? But if you've had it up to here with China and you don't want a China ETF or a fund that's heavily exposed to China because EMQQ is half China, half other stuff, just can't take it, don't want China yet, you can break your emerging markets exposure into two pieces. EMQQ has a second fund called FMQQ. It is brand new, but it is essentially EMQQ minus China. That's what it is. And then if you wanted, this is KWeb, which is the best China fund. It's technology. you could buy this whenever it is you're ready. Maybe you'll never be ready. Maybe you never want to own China. I'm probably going to buy EMQQ because the correction of the China and non-China emerging markets technology companies is in fact happening roughly in tandem. There hasn't been a gigantic bifurcation. China's leading on the way down a little bit because President Xi is crazed Xi to the max. But at some point, the China companies bottom out. They're setting new lows right now. Alibaba is the one to watch because they're the number one cloud company over there. And cloud is going to expand 500 to 600% this decade, right? You thought it was a big deal in the last decade. Why do you think Microsoft and Google got in the cloud a few years back instead of just leaving it all to Amazon? Yeah, it's a big deal. When three of the biggest companies in the world are all in the same market, maybe there's something to that. So I believe that we're getting close. Originally, this bottom orange line was up around where the price is now, about $40 a share. And when it got to 50, the price got down to 50. People were like, oh, I should buy it now. I think, no, just wait. Still got downward momentum, probably another wave down, another crazy chi to come. We've gotten another crazy chi. That real estate market over there has to be cleaned up. That'll take some time. But when KWEB and EMQQ bottom out, you have to think about having commie stocks at that point. Now, I'm not going to buy Alibaba individually. The reason being is I don't want the single stock risk that comes with China. It's not just single stock risk that you'd see in the United States. It's crazy chi risk. And I don't want crazy chi risk. I just don't want it. I'll buy the basket because any one stock gets blown up. Okay, that hurts my performance by a couple percent. But I don't want to own Alibaba and wake up one morning and have them say, yeah, we're going to break it up. We're going to give it to a state-owned enterprise and it drops 90%. Will that happen? Probably not. Can it happen? Absolutely. Why take that risk? There is a common phrase out there, you have to, the risk and reward are proportional or directly related. That's wrong. Warren Buffett has proven it. You have to control your risk, avoid the losses, and you'll accidentally make money on the rest of your portfolio. So I've broken up the plug and play stock list to really segregate out the risky stocks so that you can control your risk by only having a small sleeve of the high risk stuff. And our high risk stuff has a minimum upside of 10x. So if you're going to roll the dice on something risky, you should at least have 10x potential, right? Because you can double and triple your money with almost no risk given enough time. A couple other funds that you need to know. Yolo, right? So this is a cannabis ETF. This is Yolo. I have switched from using the Seymour CNBS over to Yolo, and you don't have to. You can really use either one. They work pretty much the same way. But remember, I've showed you the Gartner hype cycle curve. Oh, look at this. So we're down in the buy zone. I've already made my first purchase. I'll buy more if it gets down to the bottom orange line. And this is going to be a pretty substantial position. I think I'm probably going to go with 8 to 10% in my global trends. If you're a retiree, maybe not quite that much. And I have a different asset allocation for you. But if you're not against investing in alcohol stocks or tobacco stocks, then you can go ahead and invest in this too. Now, if you've never invested in tobacco or alcohol and you don't want to invest in this either, I get it. You don't have to. However, I would make the ethical argument that cannabis is better than alcohol or tobacco. I won't make it here, but I would make that argument, especially since you can have it in a brownie if you really want to. So if you don't have a moral aversion, this chart is just starting to scream at you. And that bottom orange line is probably about as low as it goes because YOLO, the millennials love this stuff. The millennials are starting to control the market. So I think you should be getting really close to buying YOLO. I've already taken my first position. This is the Wilder Hill Clean Energy, and it's getting back to our buy zone. It's pretty much just there now. Can it go down to 50-ish? Absolutely. If it heads into the 40s, a couple of bucks, yeah, sure. But the idea that it can go all the way back down to 20 something, that would be really weird. Something is wrong with the markets. That's Armageddon stuff happening. But if it did get down and touch that 2020 bottom, I would probably literally put half of my money in this fund. That's not even a joke. I go 50% this fund if you get a price in the 20s. These are 40 to 50 companies that probably almost all end up on the S&P 500 someday. That's how good this fund is, exclusive the ones that aren't US. It's the biggest trend out there. So on Thursday, and I'll put this in my underneath here, down there. I will put the link to the Money Show. So in 2022, I'm with the Money Show now. They recruited me, so I'm with that. And I will be appearing on Thursday talking about clean energy and the emerging sustainable smart everything world is what I'm calling it. And I think that you probably can see, if you buy this around 50, I literally think that you could make 400 or 500% on a fund over the course of this decade. I think this will outperform QQQ. I think that's saying something. This is ARK. Back when it was 100 and something, 120, 130, 140, 150. I told people get into the 80s, 70s, maybe 60s. 2 people told me I was wrong and they quit the service. It's in the 80s now. It's probably heading lower. But it's a good fund. You get the right price, you want it. This is the iShares Extended US Technology. For retired folks, this is actually the fund we're using instead of QQQ. Why? Because there's 250 stocks here, not just in NASDAQ, but including the SP 500 and the Russell 2000. So this is a more diversified version of QQQ across multiple indexes. It might make sense for everybody because the performance has been pretty much identical to QQQ. It's only trailed by like 1%. Rare earth metals. I use the extended chart here going all the way back to 2011, just so you can see way on the left-hand side at the top how much higher it can go. Rare earth metals will at least get to the previous highs, even though the contingent of companies is completely different. Why? Because it's that important. That's how important this stuff is. So I'm going to leave that here. I have a few more charts to add. So you can see they start coming up blank. I have my summary, and then that's all, folks. So what I would tell you here is that the large caps haven't come down yet, so you have to still be waiting for that. But you should be looking at scaling into all the small stuff. And if you didn't buy some of my higher risk stocks last year, you decide how much you want in that basket, whether it's 5% or 8% or 12%. It's going to be a number like that. It shouldn't be 20 or 30. Somewhere between 5 and 12%. Start buying that basket now, because Planet and Black Sky and Palantir, some of these companies are just destroyed because they're SPACs, or they were SPACs. Everybody hated on SPACs. There is blood in the streets there. If you truly believe that you're an investor who buys low prices, then look where the blood is in the streets and try to find those stocks that are laying in the gutter that are going to get up someday. All right. So I'll take some questions off the air, but this will be it for the recording. And join me on the Money Show on Thursday. I will get that out there for you.